I try to come up with a title for each of our presentations, and this one I came up with "Which Way from Here?" And after a period of time recently, when everything started to line up and we were talking about a soft landing, it just doesn't seem as clear where we go from here. And I've got some slides, and I'll build on this theme, but this is what comes to mind as I begin the presentation today. But let's start with financial markets. And in particular, why don't we just look at last year? Last year was the second consecutive year of 20% plus return on the S&P 500. It was an incredible year in so many ways. The S&P 500 returned about 23%, nearly double what the Dow Industrials did. NASDAQ was the leading index of the year, which really reflected a concentration of technology and telecommunications. And that's where the action was in 2024. Small cap stocks lagged. They came in at about 10%. And the Euro stock index, or developed international market, also lagged. It came in for the year at just over 8%. The Shanghai composite Chinese stocks, after a really slow start in the year, came roaring back and had a very respectful 13% return. And as we look across the entire investable marketplace globally, all the stocks in the globe that we can invest in aggregate, they had about a 16% return. One of the things that is really interesting, and we'll talk more about this, about the S&P 500, is that the concentration of those returns really came in a handful of stocks. We've talked about the Magnificent Seven. If you look at those seven stocks, they returned 48% in 2024. And if you look at all of the other S&P stocks, so the S&P 493, the return was 10%. So there was really a large concentration of returns in a small number of securities in 2024. And that's going to be material for us as we look at results. As we look at just year to date, how we've gotten started, you'll see that we're off to a strong start again. As I look at these numbers, there's a couple of things that jump out at me. First, the Shanghai Composite. It's the only broad market index that's off to a negative start in the new year, and I think that that's largely because of tariffs and the threat of tariffs. We saw news in December that China for the first time, had a net surplus of exports totaling more than $1 trillion. And with that amount of exports, tariffs can make a big difference in trade policy and in an economy. And the indexes, equities in China, Chinese-based indexes or equities, have reflected the fear and the threat of tariffs. Another thing that jumps out is the Euro stock index. Remember, from 24, it lagged. It was up 13%, still a great year, but well below what we saw in the S&P 500 and NASDAQ. This year, so to start, it really has outpaced any of the other major indexes. I guess it's up, more than twice the Dow. And that largely is, I think, finally an appreciation and reflection of just the relative value of European or international developed stocks. If you look at the Euro stock index, it has a PE ratio right now of about 16 times. And we'll see just in a moment that it's a major discount to the prices that we're paying for domestic stocks. If you look at domestic stocks, the average PE ratio is right about 22 times right now. For the Magnificent Seven, PE ratios are above 30 times. And so This gives you a sense of just the relative value of domestic versus international stocks. And I think that the market is shifting capital overseas. Number one, to avoid some of the turmoil around tariffs, but also just in search of relative value. Another way that we can look at the PE ratios are using the Schiller PE ratio. And Professor Schiller was a pioneer in measuring the relative prices of stock. It's called the CAPE, or the cyclically adjusted price to earnings ratio. And really what it is the price of stocks uh, divided by a 10-year average uh, earnings. So it smooths out the earnings. And to give you a sense of just where prices are right now, this graph will show relative PE ratios, or the Schiller PE ratio, and it just puts it into context on some of the big bubbles that we've seen historically. The TMT bubble is technology, media, and telecommunications. It's what we call the tech bubble, of course, brokerly, but it'll just give you a sense of the relative value of the market or cost of securities in the market today. And then again, going back to the Magnificent Seven, I'd said earlier in 24, the Magnificent Seven, seven stocks returned 48%, a lion's share of the return of the index. The remaining 493 stocks were up just 10% last year. But one of the things that we're seeing, and Chris has talked about this in some of his uh, uh, quarterly letters to us, is a revision to the mean. Over time, these things seem to have a way of averaging out. We've seen an anomaly. And if you just look at a very short period of year to date 2025, you'll see that the Magnificent Seven is actually negative. It's underperforming the rest of the index. So we may see a reverse in this finally after quite a long time. And just as a reminder, the Magnificent Seven are Apple, Alphabet, Amazon, Meta, Microsoft, Tesla, and Nvidia. Those are the seven stocks that make up what's known as the Magnificent Seven. If we look at interest rates, you'll see that Treasury yields right now, 10-year Treasury yields are at about 4.5%. They've been trading in a fairly tight band here over the last couple of months and weeks. We do have a normally sloped yield curve right now. For a long time, as we've talked about, it was inverted. Right now, the 2-year Treasury yield is at 4.36%. So there's about a 13 basis point slope. It's a flat yield curve, but it's not inverted. And just to check in on mortgage rates, after the Fed began to reduce Fed funds rates, there was a correlation to mortgage rates. And this is a misprint here, but 30-year mortgage rates are now at about 6.9%, just to give you a sense of another well-known interest rate index. So let's talk about the economy and the Fed. As I said, it was just over a year ago that it all seemed really kind of certain what was happening in the market. This is a graph that we used in our presentation back in November of 23. And it was clear at that point that we were heading for a soft landing. And whenever you think that there's clarity on what's going to happen next, it seems to be um, the harbinger or the threshold to disruption. But back then, if you think about, inflation was falling. It had peaked at 9%, and it was falling quite precipitously. And jobs, there was strong job growth in the marketplace. The interest rates, the Fed was lowering interest rates, and you had all of the classic ingredients for a soft landing: falling inflation, uh, growing job growth, and falling interest rates. And now today, it's not so certain. As I'll show you in just a moment, now we're seeing inflation ticking up a bit. And we're seeing a sharp drop, at least in January of our last report in jobs and job growth, and a pause in the Fed program to reduce rates. So which way we go from here is much more uncertain for sure. So let's just check in on some of these numbers. Inflation. We just saw a report for January inflation. It was up 3% on a year over year average growth of 3%. Now we know that the Fed would like to see it much closer to 2%, and it just seems stuck in this range bound area here. That's on top of uh, talks about tariff and trade policy that could potentially put even more pressure on inflation. So I think there's a real concern that inflation is vulnerable here, especially with potentially some new trade policies happening. In terms of jobs, after uh, 3 or 4 months or three or four periods of really robust job growth, we were surprised in January to see jobs had grown not even 150,000. Um, and there's a sense of weakness in the job market, maybe cyclical, maybe seasonal, but certainly there could be more pressures with federal workforce reductions and the ripple effects from that. So we'll see what happens with jobs. A silver lining related to jobs is that there's been no spike in unemployment. That's good, but the underlying factor of that is that we've not seen wage growth as robust as we had last year and even 18 months ago. So even unemployment is a little bit of a mixed bag. What we thought would be a really very steady, disciplined uh, uh, flight path for lowering the Fed funds rate has taken a pause, and the Fed is not changed rates over the last couple of meetings, and it's really in their rationale to say it's a reflection of stubborn levels of inflation and a wait and see mode and uncertainty around trade policy and tariffs and what those might mean for inflation and prices. So right now we're in a wait and see mode with the Fed. And even GDP, it was expected to come in higher. The fourth quarter came in at 2.3. For a year, probably will be closer to 2.5%. It's relatively modest growth. It's positive, but it's modest growth and perhaps not as robust as had been projected. So it's a little bit of a mixed bag, and I think that it's all colored by uncertainties of what might happen in terms of just global trade and policies going forward. As I look at slides and I look at these numbers all the time, here's one that just is out of context, but I think it caught my attention. I think that it's interesting, and it might speak to interest rates, it might speak to GDP, it might speak to a number of things, but it does speak to really very significant US debt in terms of debt relative as a share of GDP. And you can see the last time that debt was as high as it is now was back in World War II when the federal government was issuing war bonds and taking out debt to fund the war. It was later paid off largely, but today we're back in peacetime near those same levels and forecasted to go even higher. I think we're going to hear more and more about this. It's not just a political or a party question. It's an American question of just what are we doing with debt? And so this is something that caught my attention here recently, and I just thought it'd be interesting to share with you.